Welcome to Breaking News to Trading Moves. Today we are looking at how a specific technical event in the energy market can cause capital to move between related stocks pretty quickly.
Yes, our goal here is to really trace the mechanics behind a supply event involving Transocean. We'll identify which groups of companies could feel some pressure and which ones might actually benefit as money gets reallocated.
And the focus is all on the expiry of the Transocean share lockup. So let's start there. What exactly happened?
The main event is a potential new supply of shares for Transocean. That's ticker RIG.
RIG, got it.
So what happened is a 61-day lockup period, which started back on September 24th, 2025, just ended today, November 24th.
And for anyone who doesn't follow these things day to day, what does a lockup expiring actually mean for the market?
Well, it's really about an increase in the capacity to sell. When a company like RIG has an equity offering, which they did in late September,
Right.
they put restrictions on those shares sold to big buyers. It prevents them from being sold right away. Once that lockup is over, those shares can suddenly hit the market.
So a flood of new supply is possible.
It's possible, yes.
Yeah.
And that increase in available shares almost always leads to some near-term selling pressure and volatility. That's why the institutional desks watch these dates so closely.
So this isn't an issue with their business, their drilling contracts, or anything like that. It's purely a technical supply-driven thing.
That is exactly right. Their core business could be doing just fine, but if the large fund decides to take some profits or just reallocate that capital now that they're legally allowed to, well, the market has to absorb those shares.
Okay, so let's get to the other side of this. The technical pressure on one stock can create openings elsewhere. What are the groups that could potentially gain here?
That's right. Let's start with Group 1, the offshore drilling peers.
This sounds like investors still believe in the sector. They just want to avoid the volatility tied specifically to RIG, a sort of niche rotation.
Exactly. If RIG is selling off just because of these unlocked shares, investors who still like the offshore story, rig demand, day rates, they often move their money into comparable names.
So they stay in the same sandbox.
They do. They just shift to a ticker that doesn't have this supply issue hanging over it.
And which companies are we talking about here? Who are the direct beneficiaries?
We're looking at Valaris, that's ticker VAL, and Noble Corporation, ticker NE.
VALNNE.
Correct. They're direct competitors. The thinking is, if a portfolio manager has to sell RIG, they're likely to park that cash in Valaris or Noble. That flow lifts the peers because money is chasing the path of least resistance.
A classic relative value trade. Okay, so that covers the pure play rotation. But there's a second move here, a kind of safety trade, right? Group 2, the Diversified Oilfield Services.
Yes, this includes names like Schlumberger, SLB, and Baker Hughes, BKR. This is a very different move. It's a flight to broader exposure, getting away from that pure play driller risk.
Why are they seen as safer harbors when the offshore drillers get hit with this kind of technical event?
Because when a pure play like RIG gets noisy because of stock-specific technicals, institutions often shift to companies with exposure to the entire energy capital expenditure cycle, or capex.
Ah, so SLB and BKR aren't just tied to a few rig operators.
Not at all. Their business is tied to exploration, production technologies. All over the world, onshore, offshore, subsea, they're much more diversified.
So if the pure play offshore space is a little too volatile for a moment, investors can find cover in companies that still benefit from offshore activity but aren't totally dependent on the driller's stock swings. It's an operational buffer.
Precisely. They're seen as much better positioned to absorb the noise from a stock-specific event like this lockup. For them, the RIG supply is much less of a factor in their overall valuation.
And finally, there's a third group which seems to benefit just from the uncertainty being resolved. It's this Group 3, energy exposure baskets.
Yes, these are the big passive vehicles. We're talking about the Energy Select Sector SPDR Fund, which is XLE, and the Van Oil Services ETF, OIH.
So why would these broad funds benefit from one company's lockup expiring?
It's all about sentiment and technical relief. The market dislikes a known upcoming point of uncertainty. So leading up to today, this lockup was a cloud hanging over the whole offshore sector. If the day passes without huge selling,
The cloud is gone.
the cloud is gone. That removal of uncertainty itself is a positive for the broad energy and oil service baskets. These ETFs are really sensitive to sector sentiment. It's a classic risk-off to risk-on relief trade.
It just goes to show how these technical calendar dates can be just as important as an earnings report for driving short-term action.
Absolutely. The simple certainty of the date passing can be its own catalyst for these broad funds.
Okay, now let's flip this around. Where does the pressure build up? We have three groups here facing some heat, starting with the most direct one.
Right, so group one is direct lockup and supply overhang risk. And this, of course, includes Transocean, RIG. Is their stock, their lockup. They're going to face the direct sales pressure.
That's the epicenter. But the research also includes Diamond Offshore, ticker EO, in this group. Now, why would DO feel the pressure? It wasn't part of the RIG offering.
And that's a key point. DO catches what's called sympathy pressure. When you see volatility spike in one of the biggest players in a niche, and RIG is a dominant name, ETF managers and sector traders often de-risk the whole group at once.
They treat all the offshore drillers as one correlated basket?
For a short period, yes. It's often systematic. If RIG is a big part of an offshore ETF, and that ETF's algorithm adjusts for risk, it can force passive selling in other correlated names like DO, even if DO's own story is fine.
So when RIG gets a cough, DO might catch a cold.
The systemic cold, exactly. It's driven by automated trading and index rules that, for a moment, override individual company specifics.
Okay, let's look at group two. Higher beta offshore drillers. The names here are Seadrill, SDRL, and Bore Drilling, BOR. Why are they considered more vulnerable?
It's all about their volatility profile. High beta just means they tend to move more than the overall market. They're often seen as the more aggressive, growth-oriented plays in the sector.
So if the weakness in RIG suggests there's more uncertainty for the whole sector, traders might sell these riskier names first to lower their overall exposure.
Absolutely. When general sentiment around a sector turns cautious, these are often the first to be sold. Because they amplify market moves, they get hit disproportionately when capital gets risk-averse. They feel that pinch the hardest.
That makes sense. Now for the third group, which is levered oil services and offshore tilted portfolios. This seems to pull in some smaller adjacent companies. Oil States International, OIS, and Helix Energy Solutions, HLX.
Yeah, we're seeing a bit of a cascade effect here. These are smaller service providers further down the energy value chain. They really depend on the spending and the sentiment of the major drillers.
So their business relies on companies like Transocean and Valaris actually committing to new projects.
Exactly. So when RIG faces a technical dip, even a temporary one, it injects a dose of risk aversion into the market's view on offshore spending. That pressure can filter down to these adjacent service names.
So an investor might think, if the big drillers are seeing volatility, maybe they'll pause spending, and that will hit OIS's services or HLX's subsea work.
That's the thought process. It illustrates how a single supply event doesn't just stay with one stock. It forces movement across related groups, all defined by their risk profile and their place in the energy ecosystem.
So to pull it all together, we've seen how a single event, this RIG lockup expiry, can force capital to move all across the offshore sector. There's a clear distinction between the groups that might benefit and those that are under pressure.
Right, and the real question for you as you watch this is to track the volume. Is the market treating this as just a short-term supply issue for RIG, leading to that simple rotation into VAL and NE? Or is the selling heavy enough to trigger a broader retreat from the sector, hitting those high beta names like SDRL?
The volume tells the story.
The volume tells you whether this is a minor technical event or a real catalyst for a broader rotation.
We must remind you that this material is purely the opinion of the author of the original content. This is not financial advice or buy or sell recommendations.
And here's something to consider as you watch the trading over the next few days. How long will this technical supply overhang from the RIG shares actually last? Does the selling pressure disappear in a day or two as the shares get absorbed? Or does the volatility linger long enough to actually affect the outlook for the upcoming quarterly reports for those smaller service providers? That timeline is the next step in the analysis.